I would say that that is still an accurate statement to a certain degree. It was very accurate back then when we did the first refinance on that property. And what I mean by that is, the banks typically don't like the actual personal property, the mobile home themselves. They just want to basically lend on the land and income from the lot income.
Yo, what is up, everybody? My name is Matt Drouin. I'm the host of the Go Big Live Real Estate Investors Podcast, the show to listen to and to watch. If you're looking at this on YouTube, if you are a tired landlord that owns maybe a couple single family houses, a couple duplexes, mystified by the process of really scaling into doing larger commercial deals, whether it's commercial, multifamily, office, industrial, or even parking lots, which we're going to learn about today. I am psyched out of my mind to have Mr. Kevin Bupp. He's a seasoned commercial real estate investor, top-rated podcast host, and author of The Cash Flow Investor, with over 1 billion in real estate transactions under his belt. Based on his decades of personal experience, supported by well-documented housing and demographic trends, Kevin has identified mobile home parks and parking lots as the top commercial real estate investments in the current market. Increasingly known for his highly regarded private equity firm, Sunrise Capital Investors, Kevin leads the firm's vision in providing financial and time freedom to passive investors via access to real estate funds managed by Sunrise. These funds put Kevin's commitment to mobile home park and parking facilities into practice with their focus on acquiring and managing these asset types. Thank you so much for coming on the show, Kevin. I appreciate it.
Yeah, thanks for having me, Matt. That was a mouthful, wasn't it?
Yeah. I was like, hey, it makes it sound good, right? So first question I want to ask, you were born, now you're here. What happened in between?
No, great question. I'll try to keep it somewhat short and concise. But I was born and raised in Pennsylvania, Harrisburg, Pennsylvania, to be more specific, the state capital. And up until the age of 22, lived there, and have since moved to Florida. Have a family here. But the first, 22 years of my life, did the normal stuff. Went to school, high school, graduated high school. That's really where it kind of began. I didn't know what I wanted to do when I grew up, Matt. I really had no direction, no clear understanding of what was going to happen there after the fact. None of my family went to college. It wasn't really a thing. It wasn't talked about. I didn't do all that great in high school. I just wasn't academically driven. I just wasn't excited about learning about things I didn't know how I would be able to apply to later on in life or, adulthood. And so for that reason, I just didn't really apply myself all that much. But I graduated, started going to community college. Again, no direction, got a job tending bar in the evenings, and just really having fun. But it's still kind of just not really clear on what it looks like when I grow up. And that was coming really quick. But luckily, I always like a joke to say that real estate found me. I was 19 at the time, dating a girl, and her mother had recently gone through a divorce and started dating a local guy by the name of David. And David just happened to be a local real estate investor. So great individual, became friends with him, just seeing him over at the house on a regular basis. He's about 25 years my senior, and just built a friendship. And David's world was very different than what I knew growing up. We weren't poor, we weren't rich. I mean, both my parents were, had full-time jobs, working middle class, right? We never went without, but didn't have too much excess. David's very different. I dressed a little different than what I was used to growing up, had a different swagger to him, and seemed to be around. I always joked with him and said, "You're always around when old people are supposed to be working," and I would always see him over at my girlfriend's mom's house, during the daytime hours or lunchtime, which my parents are at work, right? And so long story short, David invited me to an investment club meeting, down in Philadelphia, and I attended with him, not knowing anything about his business other than he owned a lot of rental properties, mostly single-family homes and some smaller duplexes and triplexes, and that he lived on that income. That was his business. He bought things, fixed it up, rented it, and he had a portfolio of properties. That's all I really knew. Fast forward, went to the conference with him, learned a lot, was really excited. Felt first time in my life this was something I could wrap my arms around. I met a lot of people at that conference that were doing, in my eyes, huge things. I mean, they were flipping houses, making 20 grand, 25 grand, or wholesaling things. And that was more money than I could fathom. And what I identified is that they didn't seem that much smarter than I. They just knew, they had a skill set or an understanding of something that I didn't yet fully comprehend. And so fast forward, I came back and basically offered to work for David for free. And I worked for him for free for about a year as I went to school, and tended bar in the evenings. And then after a year or so of just being around him all the time, I leveraged some of his relationships, leveraged, roughly $7,000 I had saved up tending bar, and I bought my first rental property at the age of 20. So like that was really the kickoff of it. And I didn't really want to reinvent the wheel either. What David had done seemed to work, and there was no need for me to reinvent the wheel. And so that was the start of it. That was the very first property. I bought a number of more properties in Pennsylvania before I decided I just wanted to go to a different climate. I never really got used to the gray winters in PA. I know you guys have them in New York as well. I never, even growing up, I just, for whatever reason, I always struggled after fall, and getting dark at 4:30 in the afternoon, and just sunshine without sunshine for sometimes weeks at a time. And so I packed up my stuff and I moved to Florida, where I still reside today. Got a beautiful family here, but that's when things really kicked off. I mean, I ended up in my early 20s. I ended up building a portfolio of about 120 single family homes. Started dabbling in multifamily, acquired a number of smaller multifamily properties, and then my mid to late 20s started dabbling in commercial real estate. Just wanted to find a way to do bigger deals and be more efficient with my time and energy and effort. And so started buying some industrial, some retail, basically a little bit of everything. I kind of was just trying to figure out what was going to make the most money and what was going to be something that I could ultimately scale. And during that period of time, 2008 occurred, and lost pretty much everything that I had worked so hard for. Was down here in Florida, amongst a few other locations, were kind of ground zero, got hit the hardest during the GFC. And it threw me into rebuild phase. Basically, it kind of brings me back to where we're at today. So 2010, 2011, really, I took about 3 years off of really more in damage control than anything, just trying to work through the challenges of defaults and judgments, and just trying to keep my head above water more than anything else. And 2011 was a pivotal year for me. I ended up buying my first, phase 2 of my journey, ended up buying my first piece of real estate, kind of the second time around. And that was a mobile home park. It was a mobile home park that we owned literally up until a few years ago. I had never owned a mobile home park before. It was one of the asset classes I'd never considered. And luckily someone turned me on to it, and I bought that first one in 2011. And now, fast forward to today, we're a little bit more of a formalized company. We've been buying parks as Sunrise Capital Investors is my firm. We've been buying under that umbrella since 2014, and we own assets in I think today it's 17 different states. We've got about 3,500 doors that are under our ownership, and then on top of that, we also buy parking facilities, so parking garages, parking lots, and different locations across the country. So that's really, mobile home parks are our bread and butter, though. That's kind of what we've really focused on the last decade plus, and it's been a great asset class. As I mentioned before we started recording, we've owned in your home state of New York as well, and it's been a great asset class, a lot of fun, and been very rewarding for us as well.
So Kevin, before we launch into the case study for today, we want to pull apart. I did want to back up a little bit because there are some young people that listen to this podcast and that might be feeling directionless, like you were. It sounds like, just like myself, found real estate by accident, or it found me. My story was, the only reason I got into real estate is because I got a job as a teller at Chase Bank, hated it. And my dad gave me the opportunity, hey, get your real estate license, learn the business. I'm not going to give you any business. You got to make your own, and hunt your own clients, that sort of thing. And he kicked me out of the house after I had a little bit of money saved up from living rent free with him. And that's how I got into real estate. I bought a 4-family because I didn't like the idea of paying rent, because it was so cool not paying rent at my dad's house. And that's how I found real estate, right? So some people maybe aren't blessed with kind of the universe maybe guiding them or slapping them around, or, so what would you say to those people? And this is beyond the conversation of real estate, of those people that might be feeling directionless out there, and how they can actually find direction.
Yeah, that's a really good question. I think one thing that exists today that didn't exist back then, and some might argue that it's actually not a good thing, but there's so much more information out there today that's readily accessible that didn't exist 20 years ago. Like, podcasts, for example, what we're recording right now, one can even find that there's so much information, it's overwhelming, right? And how to weed through it all. But again, this didn't really exist. I think you can get a flavor, you can literally dabble and kind of stick your toe in a lot of different areas very quickly from free information that exists out in the marketplace. And so I would start there. Back then it was go to the library. I don't know, go find some books that resonate with you, or or try to rub elbows with other folks that are doing maybe bigger things, maybe not a particular thing, but just that maybe you're at a part of their life or their lifestyle is to in a form that you want to be. Maybe they're wealthy, they've got a big house, whatever. Like try to be around those people and find out what it is they're doing, and be around a lot of those people and find out of the individuals you met, like their businesses, whatever industry they might be in, what resonates with you, what you think you might be excited about. But again, I think starting with free information, there's a lot out there. There's lots of like meetup groups. I mean, there's lots of things that you can attend and partake in for little to no cost. So again, I'm not going to say that didn't exist back then. You had to work a lot harder to actually uncover and identify what opportunities were really there. So that's where I would start. I mean, again, it's just, there's lots of info out there. Just, you got to tap into, you got to start somewhere, right? Start going down some different paths and see what grabs your attention. I don't think real estate's a vehicle, and then there's a bunch of different subsets of real estate, which is just a variety of vehicles, right? Of how to make money. And you can make money 1,000,001 different ways in real estate. There's no right or wrong. And it's just finding one that resonates with you, a vehicle, and then a model behind that vehicle. If it's, trying to replace your current income or whatever it might be, you can do it anyway. It's just, are you passionate about it? Are you excited about it? And maybe it's not real estate. It could be just a business. It could be just a career, a professional career in something. But until you get out there, start dabbling and getting around people, like, I just don't think, you don't know. Some people grow up, luckily, they know. They go to high school, they go to college, they know what they want to be when they grow up, and they stick with it, and it never changes, and they're happy. But I don't think that's a majority.
Yeah, no, and also like looking at the lifestyle too, because you said that your mentor, so to speak. I mean, you're like, oh, this guy was home for lunch and that sort of thing. So sometimes it's just like, in terms of the clues, it may not just be the nice car, the big house. I remember back when I was selling real estate, I had a client who was a brain surgeon, like had, the quintessential, like more money than God, for instance. And he was desperately trying to find a house for him and his family. And every time I made an appointment to show him a house that was like the one, he'd have to cancel last second. He got called in for a last minute surgery. And I was like, I wonder what it would be like if that guy was my dad. And so kind of looking into that was really, important to me. And then I realized also after I got into business, like the people that, hey, this house came to the market, when can you see it tomorrow? Anytime, just shoot me, I can go any time between like 10 and 7 o'clock. I was like, and usually always those were like developers and real estate investors. So
Right. Yeah, they got a flexible lifestyle. Absolutely. That is a very, I'm glad you pointed out. I mean, just taking that in consideration is probably even more important than anything else. I mean, first and foremost, like what type of lifestyle is it going to like if you have a family, if you got children, like what is that? That's the first importance, right? Trying to build something around that so that if, some people try to escape their family. So maybe they need to be a brain surgeon, and maybe maybe they're trying to find reasons to go, go to surgery, go to conferences and be away and like live life on the road. Right. I don't think that's the majority, but great point that you make there.
Yeah. So Kevin, let's launch into, I definitely want to talk about the parking lot asset class, because that is something that we have never talked about in terms of asset class. We've talked about every other one under the sun, maybe the exception of cell phone towers. But let's talk about your first big deal. It was big for you at the time. That was really like where you earned a lot of battle scars in the process, and make that a case study for today's show.
Yeah, no, it's a great question. I'm gonna. It's not the biggest transaction. It's not the first big transaction I had ever done, but I would say, given where I was at in the stage of my journey in life, and just lack of capital and bad credit at that point, I'll use the first mobile home park I bought because it was kind of a rebuild phase, and while it wasn't the largest transaction size, it had a lot of new elements to me that like were scary as heck, and just create a lot of sleepless nights. And so, first and foremost, I pretty much had lost everything. My credit was in shambles, and I had just a tiny bit of money to my name. My bank accounts got garnished during, post 2008. Lots of bad things happened. My personal residence went into foreclosure. So like, I was not in a good financial state. I was finally like in a good mental state of like, I need to rebuild. I need to, get back out there and get back on the horse. Right. But the first deal coming out of that, like, it had to be a winner. Like there was no option for it to be a loser. And the risk with this one was that I'd never bought a mobile home park. While I'd owned other types of real estate, I'd never bought a mobile home park. This was 2011. the market was still, real estate was still challenged. I mean, it was still distressed in every sense of the word. This was an REO property, had been lost foreclosure, had been bank owned for a year and a half. It was fully vacant. It was a 34 space mobile home park. All 34 homes were included in the sale, which is a little different than what our normal business model is, but had 34 units there. Every single one was vacant. The special servicer had, I don't know the whole story, but basically they had non-renewed everyone's leases. They thought it'd be safer to preserve the asset by not having people live in it, which, as you know, what happens when things are vacant, they get vandalized. And so this thing sat there, got vandalized, AC units were stolen. And so we bought this property. It was 8 hours away. It was in Atlanta. We live in the Tampa Bay. It's an 8-hour drive. 2011. It's in a market I don't know. I never really bought anything outside my, 5-county wide area. I never bought anything in another state like that. And so all these new elements, and again, I never bought a mobile home park. On top of that, had no cash flow, had zero cash flow. The market was soft. The thing had already gone through foreclosure. So you start questioning, well, why the hell did that happen? Is this part of the market, more challenging than the next, right? Like what's happening here? And you have to, some of it you have to make assumptions, and some of them you just have to go by gut, right? And so we ended up buying it, and I took the $50,000 I had. I brought a partner in that I'd worked with in the past. He had $50,000. We had to raise about $250,000 from a private investor that still had faith in us back from our single family days. He still believed in what we were doing. And then basically had to drive every week, back and forth. I'd go for 2 days at a time and come back and literally run construction crews, hired a part-time project manager, basically offered like kind of a little kicker once we got this stabilized on top of like some base salary. And it was a challenge, my friend. I mean, it was, we had people steal AC units. We had, literally we would put money back in, we'd renovate a unit, and then it would get stolen again. Things would get stolen from it, get broken into. And this thing had such a bad reputation that it had been vacant for a number of years, and it became known as the place that if you wanted to go steal an AC unit or dump your trash, if you had construction debris or anything, and we continually fought this upward hill for the first year of owning this thing. And again, it had to work. I used every dime I had. If that didn't work and we lost that thing, or if we couldn't make the business model work, I was pretty damn broke, but I was completely out of money. I didn't have good credit. I didn't have any other resources to kind of to build upon. And so to me, that was probably the most important deal that I've ever done, because it built the foundation of what I've been able to rebuild here today. And so, but if that one would have gone the opposite direction, now I'm not saying I wouldn't have been, put up my bootstraps and figured it out, right? I would have fought my way out of the corner, but that one truly did have to go right. And I don't know where I'd be today if that one actually didn't go well. And again, there was challenges. It took a lot longer to turn around. The reputational aspect of it was really, really challenging. But we got it stabilized in a year and a half, did a cash out refinance, got all of our investor capital back out of the deal. And that thing ended up printing money for many, many years thereafter. But it was a challenge, to say the least. So not the biggest deal. I think total capitalized cost of that one was $350,000. Pretty small in the grand scheme of things, but by far the most important deal, I would say, of my adult life. Again, don't know where I'd be at today if that one had gone the other direction.
So let's talk about the capital stack here. You alluded to it a little bit, but it sounded also, besides the acquisition, it also needed some reno funds as well. So kind of
about $150,000. Yeah. Yeah. So again, we put the purchase was $2. We put about $150,000 into it, so about $350,000 total capitalized cost, and we put $100,000 of our own capital into the deal. The private lender basically funded the rest, and then gave us basically draws on rental costs and things like that. And that was it. It's just a private individual, someone we had done, and he did debt. He wasn't equity. He just did debt. He put this is a hard money term. I think we paid 2 points. I think it was I think it's 10 or 12%, give or take, interest only payments. And he basically gave us 18 months to get it done. And we got it done in we got it stabilized in about 14. And then we're able to do a cash out refinance to get him paid off before the 18-month mark hit. So, yeah. It was a pretty simple capital stack. Nothing too. You wouldn't be able to probably do that renovation today. It's funny. I laugh about that. Like, we literally replaced AC units. We remodeled every single one of the units, and they had good bones, but they needed pretty much everything. But we are able to do. We had to rent. I think we ended up renovating 27 to the 34. Some of them in the remainder that we didn't renovate, we sold as like handyman specials where we gave them away for a good deal. People came in and did the renovations themselves, but we gave them such a good steal in the house that like it made sense for them to do that. But we renovated 27 units, including some common area elements for $150,000, and we used some cash flow along the way, right? Whenever it started actually producing cash flow, we rolled that back in. So realistically, we probably put about 180 grand into renovations in the grand scheme of things.
So how did you stage through the unit mix? I mean, did you like, okay, let's get some cash up front first. Let's sell some of these handyman specials that are in like decent condition that aren't going to be overwhelming for somebody. Like, kind of like tell me through that, because I've been through projects like this before where I'm like, I'm buying something that's literally generating no income.
Yeah, we tried in a perfect world. We tried to actually sell some of the handyman specials first, just to get some money in the door and get some. Basically, try to keep from us having to foot the entire renovation bill right out of the gate. And it just didn't go well because it was such a bad reputation. The people we were attracting were not the people that we wanted to live there at all. And the people that we were attracting didn't have the money to even do the renovation projects. I mean, so we screened them pretty heavily. I think if we'd have sold them those units, they probably would have gone and lived in the bare subfloors and just kind of been squatters, right? Like glorified squatters. And so we had to change the reputation. So we had to kind of do plan B, which was basically, hey, let's get this thing rolling. Let's try to beautify this property, change the name of it, change the reputation, just rebrand it. One of the ways that we did that was really helpful. It just happened to be almost catty corner from the police department. And it was a drain on their resources. There was always something going on there, right? Like, and there was no one living there, but there were squatters there. There was theft. I mean, vandalism, all that, and they had to deal with it. It was right. They had to look at it when they drove to the sheriff's office. They had to drive past it, and that worked in our favor in that we ended up renovating one of the very front units in the property. And this is like a small incorporated town of Atlanta. So it's like this, they have like their own police department and all that, but it's not Metro Atlanta. And so they had limited resources. And so we renovated a front unit near the entrance, there's two entrances, but near the primary entrance where most people came in, and donated it temporarily to the police department as a substation. So we donated it to them for like 2 years as a substation. So in the evenings, police officers would come by and park their vehicle there, do reports. We always had the fridge stocked for them. We had it, it was fully renovated. You had the fridge stocked with like, Gatorade, water, things like that. Always had the heat, their air conditioning on in there. And so they used it. And folks became to know that there was going to be a police presence here on a regular basis. Not sure when they were going to show up or not, but they would be there. And so that really helped us turn the corner quite a bit in the early days of this thing, and just keeping the bad people away while we tried to get a good rebrand in place and a good reputation in order. So that was very positively impactful to the turnaround.
Oh, that's totally ingenious. Before I forget, we always talk about deal flow on this show. So how did you find this REO property?
Yeah, that one was a little bit of an anomaly, and I still think you can find anomalies here and there, but that was a LoopNet deal. And I always tell folks, like, most deals go to LoopNet to kind of die, at least commercial deals. Majority of commercial transactions happen off market or through a direct channel that brokerage has, right, their list. But very rarely does it make it to LoopNet. And if it does, it's probably because they've marketed it through their own channels. And now they're kind of doing a Hail Mary, right? And so very few things on LoopNet actually make a lot of sense. But I still scour it because what I found, and this is what really prompted me to do that, this was listed by a residential broker that was like 2 hours away. So the servicing company that took it over hired a agent to sell this, to list it. The agent was 2 hours away, not even in the same marketplace, had never listed a commercial property in his life. The listing sucked. It had no good information. It didn't say how many homes were included in the sale. It didn't say if there was titles to these homes. It didn't provide any profit and loss. It didn't have any financial information. Come to find out, there was really no financial information because it was vacant. But it didn't even have good pictures, right? Like, it didn't have good pictures at all. And so I just think that it got looked over. It didn't get good traction. And so we ended up having to drive there. This is back before you could go hire someone to get a drone and fly over it for you. And Google Earth imagery wasn't all that great, And so, like, I had to figure out what was really there. And we drove there, and I'm like, okay, there's something here. This is better than what that ad would have made it out to be, and so like that's I think that's the only reason we didn't have competition and we were able to pick this thing up for steal. And so I think they were asking originally. It started at like $595, then went to $495, then $395, and I think it was at like $350. And we ended up paying $210 for it. I said $200, but we ended up paying $210 for it. And the bank was happy to accept.
Excellent. So one of the things I want to talk about, because this is very, very important with manufactured housing communities and on the takeout financing, because you financing with private financing, a lot of even community banks and regional banks are very leery of deals that have a lot of park-owned homes on them. At least in New York State and Michigan and Pennsylvania is where I've done transactions and management and that sort of thing. So kind of like, tell me about the process of getting the takeout financing, kind of like, and give us some, actionable tips from that you learned.
Yeah, I would say that is still an accurate statement to a certain degree. It was very accurate back then when we did the first refinance on that property. And what I mean by that is, the banks typically don't like the actual personal property, the mobile home themselves. They just want to basically lend on the land and the income from the lot income. But that has changed. There's a number of regional and national banks now that will actually allow you to capitalize and use the income from the homes if you have that type of business running. When we did a refinance, that was not the case. It was a local bank that we used, and we just basically used the lot. We had got the lot rents up high enough to where we were able to do a full cash out refinance just by using the lot rental income to make the deal work and to get made whole with our investor. But it was very challenging. Up until probably like 7 or 8 years ago, it was very, very difficult. If you had a number of park-owned homes in your community, banks are very leery. Even if they weren't going to include those park-owned homes and just look at the lot rental income, they still were leery of doing the deal for whatever reason. They just didn't like the rental element of folks not owning those units. But the sentiment has changed quite a bit. In fact, there's even one of the large publicly traded companies, UMH. They've really come to the forefront over the past probably 7 or 8 years. 50% of their portfolio are rental units, and they got really nice communities. They're very high end. They own in New York. They own in a number of states. But they've really honed in on that rental model. Not entirely, but they've got roughly 10 or 11,000 rental units inside their portfolio, and they've really helped professionalize and add a new light to the rental side of our business. That's not what we prefer. We prefer not to own the home. I think in our portfolio we probably own about 400 homes. So call it 8 to 10%, but we prefer to sell the home and just own the lot. Yeah, there's a litany of different ways. I mean, if it's an older used home, we'll ideally get a cash buyer. Like in a perfect world, we would sell everything for cash. We wouldn't have to worry about having internal financing or external financing. So either just a cash buyer comes in and buys it outright, or there's a number of third-party financiers now, banks that specifically focus on financing mobile homes. That wasn't the case 10, 12 years ago. That is the case today. There's some very large ones out there. And so we have a whole sales program in place where we market these units for sale. We've got affiliate relationships with these different lenders, and we can basically approve them in-house and literally, have someone qualified and in that home with the loan in place within 24 to 48 hours. So, but that's how we do it today. Dodd-Frank and all that kind of changed being able to do it in-house. Historically, we used to be able to literally just make our own notes and service our own notes. And then that changed. I think that was 2012, maybe 2013, 14, somewhere in that range, where that no longer was the case. And so there's a number of big organizations that still do it in-house where they have to have a certified mortgage originator, and they have to be licensed in every state that they operate in. They service their own notes. But now there's third-party groups that will actually do that for you. So we don't take on the nuance ourselves. We let a third party come in and actually manage the servicing and make the loans.
Yeah, excellent. Yeah, no, I had experience working with 21st Mortgage and especially
they're
with
the big
new
one.
homes.
They're one of the big ones.
Some of the communities we manage. Yeah, and one of the main challenges we had is that our pool of applicants with people that were coming into, manufactured housing communities that wanted to buy a home, had some cash. We always had difficulty with them getting approved. And then, we went into the direction of like, okay, well, we own this, we own this house, it's in good shape. We can, hold the note on it, that sort of thing. But then, Dodd-Frank happened. And I was like, God, we're just getting stuck here. And so, and it's really, really hopeful, and hopefully things will get a lot better when it comes to not only zoning, town zoning's orientation towards manufactured housing communities, but also the banking industry. Because back about 10 years ago, it was like the 1950s. They were Jim Clayton style, like oh, hey, everybody owns their own home, they pay lot rent and that sort of thing. It's just like the model has definitely shifted a lot. So.
Yeah, I mean now, most of the loans that we do, I'd say probably 80% of the loans. Well, every property we buy today, it has to qualify either today, or we know that it will qualify in the next couple of years based on our business plan for either a Fannie Mae or a Freddie Mac loan, which is very similar to what those in the multifamily space can expect. The best terms, 30-year amortization, basically the lowest rates in the industry for, if you're comparing against like regional and national banks or credit unions or anything like that. And lengthy interest only periods. And so, fixed term for 10 years. And so like literally the best terms in the biz. They're very active in the space. And so anything that we buy today, we want to know that it's actually going to qualify based on their parameters. And they don't like the park owned home thing. And if it's got more than 25% park owned home, or if their threshold is 25%, so 25% or less, they'll do it. They'll make exceptions for maybe up to 35%. So long as you got a good plan in place and they can get on board with it of how we're going to sell off 10% of that and get it down to 25% or below over the next year or two. But they're very active in the space, and now they're fighting each other. Who can deploy the most dollars into this sector, whereas 10 years ago that just wasn't the case. I mean, I remember deals dying because I would call 50 banks and 48 of them didn't understand the asset class at all, and the other two that said they could do the deal, you get the ball rolling and then they would back out for whatever reason, right? And so just banging your head against the wall to get the deals done. Now it's the opposite. There's more banks than not that are fighting to get into this asset class.
Absolutely. So we're getting short on time here, Kevin, but I wanted to talk about parking facilities and the why and how you discovered that. Because, like, in my opinion, I mean, it's like where is the value? It's like it's a little bit of an upgrade above dirt. Are these parking garages or are they just parking lots? Like, tell me about that whole story.
Yeah, well, they're both parking lots and parking garages. We buy and own both. As far as how I found out about it, I on my podcast, I've been running it for 10 years now. I like to do some out of the box interviews every once in a while, especially on things I don't know anything about. And I think it was probably 6 years ago. Just happened to meet a guy at a conference that was a broker in the parking lot space. And I'm like, what? I'm like, I didn't even know. I mean, like, everyone knows somebody owns the parking lots, right? And if you go online and try to find a broker that specializes in the parking, there's literally like 5. And he was one of the 5 that exist. And I had an interesting conversation with him, and I ended up bringing him on my show. And I was so intrigued just by the business model, because everyone knows you've paid for parking. I've paid for parking. We've all gone somewhere we paid for parking. Some of them are city owned, so that goes back to the city's coffers, but plenty of them are privately owned, right? And so it's a business for somebody. It's a piece of real estate that's got an income stream, and I just never considered it. And so I just had a lot of very just detailed questions for him so I can understand the business model. Like, where's the nuance? How do you make money? Like, how would I identify a good opportunity from a bad opportunity? Just all those things, demand drivers, all that kind of stuff. So I was intrigued enough after that interview that I couldn't not stop thinking about it. And a year went by, and we attended a number of parking industry conferences, just to try to get a better sense of the space. 2 years go by, dug even deeper. And then by year 3 of just investigating the space, getting to meet people in the space, the operators, the owners, we decided to buy. And that was 2020. We bought our first property. It still makes up the minority piece of our portfolio. We've got about 100 million of parking assets under ownership today, but we're very strategic in our approach. Most of what we own is in a thriving downtown area. So we typically stay away from any of the downtown areas that were majorly impacted by COVID, right? Where maybe things aren't even open back up completely. So we own in downtown Phoenix, across from the courthouse. We're about to close on a property in downtown Charlotte, right across from the Spectrum Center where the Hornets play. Charlotte's a thriving market. Downtown Wilmington, North Carolina, right by the waterfront, right in the entertainment district where all the bars, restaurants, and entertainment is happening. So like we own in Clearwater Beach, we own one right in our backyard, which is literally it's the only standalone parking garage. There's a moratorium on new garages being built. We actually bought it from the city. They weren't running it correctly. And it's surrounded by tourists and restaurants and bars and all that. And so we like to think of it as irreplaceable real estate in irreplaceable locations, but that today makes a ton of sense from an economic standpoint as parking. So like the highest and best use today is still parking. So it's got to stand alone on its own as parking from an income stream. We got to know that we can buy it, add value to it. To your original question of like, how do you, like, what are you looking for? Like, how do we add value to one of these properties? And what we have found a lot of times, it's just a couple simple things. Like the first property we bought, they weren't even accepting credit cards. Like there was no, I don't travel with cash anymore. And so I wouldn't have parked in the lot because I never have cash on me. And so they were collecting cash. That's one problem. So anyone that had a credit card couldn't park there. And so they were missing out on an opportunity. Number two, they weren't adjusting their pricing based on supply demand time. So like Friday night and Saturday night should be charging more per hour than you do on a Tuesday night, right? It's just basic common sense. They weren't adjusting their pricing for demand, peak times. And then lastly, being that they were accepting cash, a lot of that cash doesn't make it back to the owner. If you got a lot of tenant collecting cash, I can promise you that some of it's going into Hip National Bank, right? And so, in that particular property there, we literally went in, we identified that their hourly rate was below market by about $2 an hour. And then they also, again, weren't adjusting for different peak periods of time. And then they weren't accepting credit cards. So we bought that property. It was doing $38,000 a year of NOI. And before we even closed on it, we went and pre-negotiated a triple net lease with a local operator that knew the market really well. He knew the data points and he knew what the property could really do. And we basically signed a triple net lease at $72,000 a year, literally before we even closed on the property. And then come to find out, we actually get data from this third-party operator. Part of our lease is that we want to see what it's really doing so that we can, plan accordingly with refinances and things like that. The first year of ownership, so they're paying us $72,000. It had $38,000 of NOI, so we doubled the NOI before we even closed on it. The first calendar year, so we bought it late 2020, so the calendar year of 2021, it did $141,000 of gross revenue. This is like a 30-space surf lot in downtown Wilmington. Absolutely crushing it. And it's asphalt, right? It's asphalt. And the cool thing about this property, this is like, one of the things we look at, it's got air rights. And so today it makes the most sense as parking. It still crushes the game of life, makes a ton of money, easy to operate. We leased it, so we're not even dealing with it. They pay all the expenses, the insurance, the taxes, all that. We've refinanced that. I mean, we've got all of our cash back out of that one fairly quickly. But let's say 10 years goes down, 15 years down the road. We don't speculate on what it's going to be down the road, but I know that it's got opportunity down the road. It's just a matter of when. At some point in time, there's going to be a higher and better use of that property. And so like back to the point of like irreplaceable real estate in an irreplaceable location, right? Like there's only so many plots of land that have air rights in downtown Wilmington that can be either in the historic district that can be redeveloped. So we look at things like that. It's got to stand alone today as parking, but I also have to know that there's a future. Whenever that future comes, whether it's 15, 20, 25 years, when there's a higher need for something else other than just parking, that plot of land will be worth way more something else. So it's kind of like icing on the cake.
Mm-hmm. No, absolutely. So last question before we get into our parting words of advice. How do you finance asphalt? And, sometimes these things are daily parkers, perhaps, obviously, triple net lease would give with a known operator would give a bank some comfort level. But yeah, tell me about that.
Yeah, that's a great question. It's so long as there's decent financials in place. No matter how antiquated they might be, if it's like hand drawn ledgers or whatever. I mean, so long as you've got some type of financial data that shows that there's a steady income stream on an annual basis, and getting financing on it's really no different. Think about it, it's really no different than a mobile home park when you think about it. Really, it's you're leasing or renting the dirt. And if it's in a desirable location, most banks can get comfortable. Forget about the income stream. If the actual parcel of land just happens to be in a very desirable location, they can understand that. They can at least understand that part of it, right? That land has its own intrinsic value. Forget about the income. And the income is almost like it's like icing on the cake, right? And if they can understand that business model, that people are paying for parking and they have for the last 20 years in this lot, and there's data to support it, normally you can get a much higher, loan proceeds because of it. So, we haven't ever had an issue getting financing. I mean, the last couple of years have been a little more difficult, but for example, the property we're about to close on in a couple of weeks, it's actually a bank out of Chicago that it's not CMBS lenders will always lend on parking. They like the asset class, but their loan proceeds typically are a little lower. But we've got a bank based in Chicago that they're in Chicago, so they've lent on parking before. They like parking; it's been a good part of their portfolio, and they've got really attractive terms. So they're doing this deal for us. They've done another deal in the past for us, but it is definitely niche-y. It's taken us years to really uncover the banks that are the best, that really like the asset class. Life insurance companies like parking as well, so you can get loans through life cos on a regular basis, but loan proceeds are typically lower as well. So getting lending on them is not difficult. It just takes a little bit more effort and work to find the right suited lender. It's not as easy as multifamily or retail or some of the other mainstream asset classes.
Mm-hmm. Kevin, we've gotten so many gold nuggets out of this episode. I want to end with this question for our audience out there. They're experienced real estate investors that want to start scaling and doing bigger deals, but kind of mystified about the process and how to get started. What are some actionable type of things that they can do today, this week, this month to get them moving in that direction?
Yeah, I mean, I think the quickest path to get there is this is assuming that you kind of know which path you want to go down, as far as hey, I want to go buy multifamily, I want to go buy my first industrial property, whatever that is. That's assuming that you know what direction you're going to go. Go find someone that's already doing it, right, and try to align yourself with them. How can you bring value to them and their business? And you can try. It's pretty easy to find people now, right? Again, we're talking about this podcast. It's pretty easy to find people that are actually out there doing what you want to do. You go to iTunes and search keywords, right? If you want to go buy mobile home parks, you search keywords of mobile home parks or industrial or retail, and then track down those people, reach out to them. I think people today they're definitely way more accessible, but and then most entrepreneurs, generally speaking, most are willing to help out the next person, right? Willing to lend a hand. We've all had folks that have helped us along our way and helped us find success in this world. And so most folks are willing to give back and give advice or give guidance. Who knows? You might find someone that's looking for someone that literally has your skill set, and you can literally join their organization and bring value in that manner and just be around them on a regular basis and learn what they're doing and how they're doing it. So I don't think it's rocket science. I don't, Matt. I think that if you're willing to put the resources and energy into it, the information's there. You just got to go out and uncover it and then take action. Pick up the phone, write an email, and put some action behind it. Excellent.
That's money advice. Kevin, before I let you go and we go in the green room here, I want to allow you to highlight anything you're doing right now that either Sunrise Capital is doing a raise for, and how our listeners can get in touch with you and learn more.
Yeah, no, I appreciate that. Yeah, I mean, if you want to learn what we're doing at Sunrise, we do have an active fund that's open that we're currently raising for right now. We've got currently 6 assets in that fund. We've got 2 under contract now that will be closing by the end of the year. But that's not the reason why I mentioned this. I mentioned, Sunrise and what we're doing because you can learn a lot. Our website's pretty informative. We've got we're pretty transparent. We put third-party reports up. We put appraisals. We put a lot of granular details about properties that we've gone full cycle on, kind of the business plan behind it. And you can learn about that as well as our offerings by going to investwithsunrise.com. Again, if for nothing else, just for educational purposes, you can go there and just get a sense of what we have going on and how we do it and why we do it. And then I've got a podcast as well, Matt. They can go to my personal website, kevinbupp.com, and learn about a little bit more about me personally, as well as listen to my show, which is where I host it. So,
excellent. Kevin, thanks so much for coming on the show, man. And I look forward to seeing you in the green room.
Yeah. Thanks, Matt.